Right, everyone. Welcome to this week's edition of Wealth Wednesday. Today, we're going to be talking all about required minimum distributions. And I think this is an often, overlooked topic with so many people having the majority of their retirement accounts in tax-deferred accounts. However, I think it's one that every retirement plan should focus on. And so let me know if you guys can hear me, if everything's working technically, and then we'll go ahead and get started. While I'm waiting to hear if everything's working, I'm going to share my screen. All right. Wait a second. Right, can I switch it back now? All right, perfect. All right, so yeah, let's go ahead and get started. We're gonna be talking about how to minimize RMDs, how to save on taxes, and extend the life of your retirement savings by minimizing RMDs. And so I want to start out with a thought experiment, and it's one we've shared inside of our email list in the past, but I think it's kind of an interesting way to look at tax-deferred accounts. And so let's imagine you're sitting at home and you hear a knock on the door or a ring of the doorbell, and waiting at your door is a salesman, okay? And his name is Sam. And Sam asks you, I have a business opportunity for you, and I want to see if you want to invest in this business, okay? It's a business that has made a substantial amount of people rich. A lot of people have invested in this business before, and so here's how this business works, okay? Of the money. So we're going to go in business, and you're going to put up all of the money. You're also going to put in all of the work. Okay, so you're going to have to choose how that money, how this business invests and grows. And because it's your money, because you're putting in all the time and resources, you're taking really all the risk. But so here's the kicker. Sam, though, is in complete control. And down the road, Sam will tell you how much he's going to take in profits. He's not sure what it's going to be right now. He's going to see how the business goes. And at some point down the road, he's going to let you know how much he's going to take in profits. Now, would anybody invest in this business? Right? This seems very one-sided. Most of us, I think, would slam the door on Sam, if not kick him off our porch. But interestingly enough, we would all say no to investing in this business, but this is kind of what a tax-deferred account is, an account like a 401k or an IRA. Okay, when you invest, when you put money into these accounts, you put up all of the money. Okay, every contribution is money that you're putting in. You're putting in all of the work. Okay, you're deciding what to invest in, how that money grows. And you're also taking all of the risk because it's all your money and because it's all your work. And so in a 2008 type event, when the market's down 50%, that's your money that's down 50%. Now, Sam is in control of these accounts. He tells you that you can't take any of the money out before 59.5. And by the way, Sam in this scenario he tells you that money out before 59.5. He says after 72, you have to you're forced to take money out. This is what we're talking about today, required minimum distributions. And then down the road, Uncle Sam will tell how much of this account is his share. Now, we know today if we took all of that money out, how much would go to Uncle Sam, but we don't know where taxes are going to be in 2030 or 2040. That's up to Congress, and they could be substantially higher than they are today. They could be substantially lower, but we just don't know. And so Sam's share of the profit, if you will, is unknown in the future. And so interestingly enough, everybody would say, no, I would never invest in this business, but almost all of us are doing so with our tax-deferred account. So just kind of an interesting, thought-provoking kind of scenario from the start. And it kind of leads into this discussion about required minimum distributions. If you're not sure what those are, when you put money into a tax-deferred account, you get a tax deduction. So if you put $10,000 into a tax-deferred account, it basically eliminates $10,000 from your taxable income in that given year. Now, the IRS allows that money to be grown tax-deferred, and they only receive their taxes once you pull that money from those tax deferred accounts. Now, the issue here is that the government wants their fair share of your account, essentially. And so they're not just going to let you have that tax deferral power forever. And so at 72, it used to be 70 and a half, they implement what's called required minimum distributions, which basically forces you to take money from these accounts. It forces you to take money, therein they get their taxes. Okay, so at 72, your required minimum distribution, whether you need that income or not, might be, let's say, $50,000 that you have to pull from this account. Well, that's money that you now owe in taxes. And again, they force you to take it whether you need that money or not. If you don't need that money, it can cause you to owe extra taxes that on income you really don't need. And so this is why, again, we're talking about this subject, because it can really throw you in a tax pinch. But we'll get to that in a sec. So here are the accounts that are generally affected. Most accounts, in fact, almost all tax deferral accounts are affected by RMDs. So that would be things like a 401k, traditional IRAs, okay, thrift savings plans, profit sharing plans, simple and SEP IRAs. So basically anything where when you put money in, you get a tax deduction, you can pretty much be sure that that's eventually going to be affected by RMDs. So things that would be excluded would be Roth IRAs, would be taxable accounts, or HSAs. All of those would be excluded and are not subject to these RMDs. So oftentimes, a question we often get is, how much do I have to take for an RMD? Okay, and if you go to the IRS's website, they have a table that's laid out that looks a little bit like this. I just snapshotted a few of them. They have it laid out anywhere from, when you were in your 20s all the way to something like 115. And so they lay out a formula that determines how much you have to eventually take as that RMD. And so basically, what this formula looks like is you would take your previous year's ending balance. So let's say we ended the year in 2020 with $500,000 in our tax deferred accounts. Let's say it was all in a 401k. Okay. Well, let's say in 2021, we're going to be 72. Okay. So on the chart here, we see that at 72, our distribution period is 25.6. So what does that mean? Well, basically what we would do is we take the previous year's ending balance and we divide it by this distribution period. So quick calculator up here. We have a $500,000 ending balance, and then we would divide that by 25.6. Remember, that's that 72-year figure, and that would give us a RMD of $19,531 that we now have to take as income. Okay, and so what's important to note here is that this distribution period number goes down over time, which means that your RMDs are going to go up over time. And so let's say we had our $500,000 401k. We took that $19,000 RMD in this year. But let's say this year our investments grew quite well, and that even after that distribution, that $500,000 account grew to $525,000. Okay, well, notice that next year, this distribution period number is 24.7. Okay, so if we go back to this calculator and we just assume that we have a $525,000 IRA or a 401k, we divide that by 24.7, and now we see that our RMD is going to be over 21,000, and so it's $2,000 higher than it previously was. And so it's important to note that once you're subject to RMDs, if you expect any reasonable growth in this account, your RMDs are going to go up over time. And so it creates a situation where if that first RMD really puts you in a tax pinch, a bad tax scenario, it's likely going to be a situation that you have to deal with for the rest of your life. Okay, so this is why it's so important to deal with RMDs before we're required to take them out. And so just a couple finer details about RMDs. In 2019, at the end of the year, they passed the Secure Act. Basically what that did is it moved RMDs from 70 and a half, which was the previous age they started, and now move them to 72. So essentially you have a year and a half extra to plan for these distributions. How RMDs work after death. So let's say you were subject to RMDs, you pass away and you pass those accounts on to another beneficiary. If it's an ineligible beneficiary, meaning that it would not be your spouse, let's say it was a younger child or a younger, or let's say it was a different family member, they would be subject to what's now the 10-year rule. So the Secure Act implemented a 10-year rule. Basically what that means is, let's say you have $1 million and you pass it on, you pass on that $1 million 401k to your 35-year-old son. Okay, well, that 35-year-old son now has 10 years to withdraw all of the money in that 401k. So given it be $1 million, they would have to withdraw $100,000 plus probably per year for those 10 years, because there would be some kind of growth there. So second rule, or second way to deal with RMDs would be if that IRA passes to a spouse. So that would be basically what's an eligible beneficiary in terms of the IRS. And basically they have two options. So they can adopt that IRA and basically adopt it as their own. So then it would basically their RMD would change based on their life. So let's say you were 72, you pass away, goes to your spouse. Well, if they now change it and essentially own this IRA now, that RMD table will now be off of their life. So they won't have those RMDs until 72 themselves. Or the other option would be to inherit that IRA. And then basically it enters into what's called the uniform life table. So basically just lays out a different RMD table, if you will, and that person will have to take RMDs each year. So it's important to note, however, that there is a massive penalty for missing or miscalculating your RMD payment. So let's say that in a given year, your RMD was supposed to be $15,000. Okay, and for some reason you missed it for that. The IRS implements a 50% RMD penalty. So that would be, in that situation, $7,500 extra as a tax penalty for missing that RMD. And so it's ultra important to make sure, one, you take your RMDs on time, and make sure you take the right amount for your RMD as well. In 2020, if you were subject to RMDs, you didn't have to take them because of the CARES Act allowed beneficiaries to basically forego that RMD in 2020. Now, 2021, I don't believe we've seen anything that allows you to forego it for this year. So you will be subject to RMDs again this year. So just another kind of quick detail to note are the aggregation rules around RMDs. So let's say you're married and you have a 401k, an IRA, and a 457 plan. So you definitely have three different types of tax deferred accounts. You can see the values here on the screen, and you can see the corresponding RMD that you would owe. Now, it's important to note that you can't just take, so basically the total RMD you're going to owe is a little bit over $38,000. You can't just take all of the RMD off from one account. Okay, it breaks these aggregation rules. You can lump these accounts together. So let's say you have 5 IRAs that are totaling $250,000. You can take your IRA RMD out of just one IRA account. But as far as different account types, meaning 401k versus IRA versus 457, you have to take the RMD specifically out of that account. So you have to take $15,625 out of one of your 401k accounts if you have multiple. You have to take $9,765 out of one of your IRA if you have multiple. Same with the 457. Okay, so there's somewhat separation between where those RMDs have to be paid from. Just an important thing to remember and note kind of as you're planning for this situation. But how should the average person in this group think about RMDs? And I see a lot of different opinions out there on the internet. I've seen people even kind of promote that you should be maximizing your RMDs. And I just think that's ludicrous. Okay. RMDs for the average person in this group is going to be what I think is one of the biggest tax bombs, if you will, that can go off in your retirement. For most people that we plan for, and again, our average client is typically has investable assets of $500,000 and above. But for that type of person, we see RMDs being a huge liability, especially depending on how you're coordinating the other pieces of your retirement. And so this is something that I believe everyone that has some sizable assets should be looking to minimize, and not right before they turn 72, not when you're 71, but rather from the start of retirement. Okay. This is you need to be planning for these RMDs, I would say at least 10 years ahead of time, again, depending on how big your assets are. So for many, though, it's going to be a pretty large liability that we want to make sure we minimize. So this is something I'm sure we've talked a lot about in this group, and it's kind of the tug of war that America is having right now. Okay, we are at historically low taxes, and we are at historically high debt. And so we have a tug of war between our country isn't taking in a ton of tax revenue relative to how much debt we have. And I like this chart here on the right. It's an old chart. Okay, it was developed in 2015, and that's kind of why I like it. So basically in 2015, a child born in 2015, basically every citizen in America, their share of the national debt was $41,000. Okay, meaning that to wipe out the national debt, we'd all need to stroke a $41,000 check in 2015. Well, notice by 2032, when this child is supposed to be 18, that share of the national debt is supposed to rise to $91,000. Okay, excuse me. And the reason I like to show this is because when in 2015, the estimate was way out in 2032, the share of the national debt was going to rise to $91,000. Well, we're sitting here 5 years later, and I believe the share of the national debt for each person is something like $82,000. And so in 5 years from this last estimate, we've doubled your share essentially of the national debt. And so it's no secret that the government is spending like no other. And it's a situation, again, we have historically low taxes, but historically high debt. And so at some point in the future, something needs to give. As a country, we either need to spend less, which I don't hear talked about too much, or we're going to have to tax more. Okay, now how many ways does the government have to make money? They really only have one. Okay, sure, they can take on more debt, but that's not really making money. Okay, the only way they have to make money is to tax the public. Okay, and so I believe as we go forward in the future, we're going to be seeing higher taxes. And so right now there are some unknowns that really no one knows. Okay, the first big one is how much of your 401k or really any tax deferred account do you actually own? Okay, so let's say you have a $500,000 401k. How much of that 401k do you actually own? Now, most people give me a funny look when I ask this. I own $500,000 401k, so I own $500,000 worth of the 401k. And that's not exactly true, because as that money gets pulled out and you use it as income, it's going to be taxed. And so that is that $500,000 is pre-tax. But to actually what we own, we'd have to look at it after tax. And so we only know the tax rates this year. Okay, if we pulled it all out in this year, which I would not recommend, we would know that we would lose a significant portion of it to taxes. But we're going to be pulling it out each and every year through retirement. We don't know where taxes are going to be in 2030 or 2040. And so we don't really know how much of this 401k we actually own today. Okay, and on that same note, we don't know where future RMD tax rates are going to be either. And so we know we're at historically low tax rates right now. But in the future, when we have RMDs in 2030 and 2040, how much are we going to owe in taxes on those RMDs? And we really don't know. However, in this tug of war that America's going into, I believe taxes are what's going to lose out, and taxes are going to end up going higher in the future. And so this is just something to keep in the back of your mind as we walk through this. But again, we're at historically low taxes. If we look back into the past, after World War II, which we're at similar debt levels as opposed to how our GDP as we were in World War II, and the top tax bracket back then was 94%. Okay, so again, we are in a great tax environment. We don't know how long this is going to last for. But what if taxes don't go up? Okay, are RMDs still a problem? And the answer is yes. Okay, and it's because of this chart on the screen right now. If you haven't seen this chart, haven't been a part of this group, this chart gets created when you turn on Social Security. And so the blue chart on the bottom is basically your normal tax rates. The red brackets here are your tax rates after you're on Social Security. Okay, and this creates what's called a Social Security tax trap. Okay, and basically what it's showing here is right here, as you take more income and your taxable income goes up, it will cause more of your Social Security benefit into becoming taxed as well. And so you're going to be taxed on the income that you take out from, let's say, IRAs, as well as taxed on the Social Security, as part of your Social Security benefit. And so it creates basically a double taxation. And so in this zone right here from in this about $45,000, they are in essentially a double tax zone. We call this the Social Security tax trap or the Social Security tax torpedo. And so let's say prior to, I'm actually going to grab my pen here if I can. Let's say prior to RMDs, they were over here where the majority of their, basically they were in a zero income bracket. So Social Security was the bulk of their income, which was largely untaxed, and then they weren't taking enough from their IRAs to be taxed either. Okay, and let's say, so at 71, they're at this red line here, and then 72 starts, and they have an RMD that, let's say it's $40,000 worth of an RMD. Well, notice here that they're going to be forced to be taxed at everything through here. Okay, and it looks like at 10,000 to 40,000, they would be over here. And so their RMD is forcing them into the Social Security tax torpedo and costing them 15, 18, then 22.2, and then 40.7 on each portion of those distributions. And so this is a huge thing that we need to make sure we protect against as we're subject to RMDs. But let's go into a more specific example. Okay, so this couple ended 2020 with an IRA balance of $896,000 and are turning 72 in 2021. And so here we're looking at basically their Social Security trap chart. And so prior to having to take RMDs, their income was right here. Okay, so they were subject to a little bit of the Social Security tax trap, but it wasn't too bad at this point. And after RMDs, which are, I believe in this instance, are going to be $35,000, it's going to raise their adjusted gross income right in the middle of this tax trap, which is going to end up costing them 40.7%. Okay, and so let's look at how this breaks out. Okay, so their estimated RMD here is going to be $35,000. Now, this RMD is going to bump them into the next tax bracket. So part of their RMD is going to be taxed at 12, and then part is going to be taxed at 22%. And so the total tax on that essentially IRA withdrawal is going to be $6,275. But know that RMD, the amount they take as income, is going to force more of their Social Security benefit into becoming taxable as well. And so they're going to be double taxed. They're going to owe it on the RMD and then on the Social Security benefit as well. The total tax, again, as that Social Security benefit moves into becoming taxable, it's going to be taxed at 12 and 22, just like the RMD. And so in total, they're going to owe $11,608 in taxes, which in their case is 33.2%. I believe this isn't even calculated in state. So state on top of that might be even another 6%. So they might be closer to 40% in total taxes that they lose on this RMD. And so a $35,000 RMD only ends up basically as a retained RMD of $23,000, almost $400 at that point. And so they're losing a huge part of this RMD to taxes. And so if they're stuck in this situation, this is going to continue to be a situation really for the rest of their life, because their RMD is very likely to go up as we move through their retirement, as we move through time. And so again, in a situation where that $35,000 is causing them to be taxed at 33%, which for this couple for sure was a wake-up call. They had no idea because they didn't factor in that additional Social Security benefit being taxed. And so this can certainly create an issue where it can cause you to lose a lot in taxes. And every dollar you lose in taxes is a dollar that you can't take as income and spend in your retirement. So how do we avoid this RMD tax bomb, or this RMD tax landmine, if you will? And there's two ways. First, you need to have a forward-looking tax plan. So let's say you retire at 62. Well, from 62, you should have an estimation of what your RMD is going to look like at 72, even though it's 10 years beyond, because this is a situation where you want to start planning and minimizing those RMDs as soon as possible. Okay, minimizing them at 62 will have a compounding effect by the time you get to 72. Okay, and there are different obstacles that we're going to have to account for along the way, from healthcare premiums to Social Security. Okay, and so we need to start well ahead of time and plan ahead in order to deal with these RMDs. But then once we know what these RMDs are going to look like, we need to avoid and minimize, which might sound complicated. Some people might make it complicated, but it's really just blocking and tackling inside of your retirement plan. So I want to go through 7 quick ways that you can minimize RMDs to make sure that it doesn't end up being a nuisance and costing you the significant taxes like that couple we just showed. So the first one is to delay Social Security. So often what I hear from the average retiree is they retire at 62, let's say, and they immediately want to file for their Social Security benefit. Okay, the reason being is because they look at, if they delay their benefit, the income has to come from somewhere. Okay, which typically means it has to come from your retirement assets. And so they view delaying Social Security as they're going to use up a large portion of their retirement assets. And counterintuitively, that's not using up your retirement assets isn't always such a bad idea. Okay, so in this scenario, we had somebody that filed for Social Security as immediately when they retired. Okay, and notice what happens to their RMDs. This orange line here is their income need. Okay, and you'll notice that this green RMD is causing them to take out more income than their income needs. So that ends up just being wasted money. Okay, you're being taxed on money that you don't exactly need. And so in total, this person ends up paying over $276,000 in taxes on these RMDs throughout their life. Well, notice here that if they delay their benefit, okay, and by doing so, they use those tax-deferred assets while they're delaying their benefit. And you would do that for 2 reasons. First, you would do that to save on RMDs, okay, because as you use those assets, it's going to end up with it. You're going to end up with a smaller tax-deferred balance. But then number 2, we're in low taxes right now. So let's use what's going to be taxed at the highest rate early in retirement before taxes potentially go up. And notice by delaying Social Security, in this case, I believe it was to 70, they end up owing significantly less in tax-deferred taxes and end up with a savings of $172,000 just on taxes, okay, throughout their life. And so that's a huge tax savings in this scenario. And again, it's just by delaying Social Security. They didn't even need to do any Roth conversions or any other strategies on top of that. But that leads us to the next one, which is Roth conversions. So we've talked about it before in this group, but a Roth conversion is basically taking money from an IRA, paying taxes on it today, and converting it to a Roth IRA, which you never have to pay taxes on again. Okay, and the Tax Cuts and Jobs Act, prior to the Tax Cuts and Jobs Act, this was the tax rate. And then after the Tax Cuts and Jobs Act, it updated to this. And so this is set to expire in 2026. But notice here that basically across different tax brackets went down 3 to 4%. Not only that, but the standard deduction went up. Now, again, these are going to revert back in 2026 to the previous tax rates if Congress doesn't make any changes. And so right now we are in a Goldilocks zone, if you will, for Roth conversions for paying taxes right now. So it's important to note that while you're working, you may have made too much to contribute to a Roth IRA, but there are no income limits on conversions. Okay, and we often hear that a myth of conversions only makes sense if taxes go up in the future. And I think we showed with that RMD tax scenario that taxes don't need to go up in order for your tax rate to go up because of different hurdles like the Social Security tax trap. So again, just jumping through a quick example. This is someone's situation where once again, we see significant RMDs through here. This is just wasted taxes. It's just money being flushed down the toilet because they are paying taxes on income they don't readily need. Okay, and so is there a way to deal with this? In fact, yes, in this scenario. And basically their way was just to max the 22% bracket for just 6 years. Okay, so all the way into 2026. And notice here that maxing this 22% bracket definitely resulted in some substantial Roth conversions. But notice over here, the estimated lifetime tax savings. And we see that the RMDs are much more under control over here. They're still there. They're still apparent, but they're not causing you to owe more in taxes than you necessarily need to. And so the estimated lifetime tax savings in this, just again, a simple Roth conversion scenario is almost $236,000. Okay, so once again, delaying Social Security and implementing Roth conversions can significantly help on minimizing these conversions, these RMDs. Another one, again, blocking and tackling technique is something called asset location. So every day you'll hear in the news everybody talking about asset allocation. What should you hold? How much stocks, how much bonds should you hold? Nobody talks about asset location. And so in this scenario, we have somebody with $1 million in assets. They have $750,000 here in an IRA and $300,000 in a Roth IRA. Okay, and they're going to be investing in just a regular 60-40. So how do most people allocate? Well, they put 60% of the stocks in the IRA, the traditional IRA. They put 40% of the bonds in the traditional IRA. They do the same thing in the Roth. They put 60-40 in the Roth as well. But this doesn't make a whole lot of sense if you think about it, because the Roth IRA, we've already paid taxes on. So this is money that will never be taxed again. So it's an account that we want to grow as large as possible if we can. Now we know that stocks should grow at a greater rate over the long term. So what would make more sense if we're thinking about asset location is to put all of these stocks, I'm going to try to write it. I might not be able to write it out here. All of these stocks in the Roth IRA and then split up the traditional IRA, okay, which would mean that we would have $3,000 of the traditional IRA invested in stocks and $400,000 invested in bonds. again, we want the lower growing, slower growing assets like the bonds all in the IRA. What this, or the traditional IRA, what that's going to do is it's going to grow that account slower and inherently minimizing RMDs along the way. Okay. Going back to this previous example of this couple losing 33% to RMD taxes. So let's say after their RMD, they find themselves here. Now notice here, they have a little bit of the tax trap left, that if they take out more income, they're going to be subject to that 40.7% bracket. But then their Social Security is going to be done being taxable. And so what might make sense is for them to take out more than they actually need in a given year. So if they find themselves here in 2021, they should maybe take out and withdraw all the way to here, which would be, call it another $40,000. Yes, they're going to be owing a little bit extra tax here, but then they're going to be back to that 22% rate. And so what that'll do is the following year, because they took out more than they needed, it's going to cause this RMD to be slightly smaller. Okay. And so sometimes it can make more sense to take out more than you need in a given year if you're past this tax trap. And by doing so, you're going to be minimizing future RMDs. Okay. Because even paying at 22% right here makes more sense than being taxed again at 40.7. So we want to take out enough that we can try to avoid this tax hump right there, if you will. Okay, and just kind of 3 more quick strategies. If that's income that you don't need and you're someone who's very charitable minded, there's something called a qualified charitable distribution that you can do. You have to be at least 70.5 in order to do so. I don't believe that updated with the Secure Act. I believe it's still 70.5. But one of our accountants in the group might want to check me on that. Doing a qualified charitable distribution, which basically means you can take that RMD, let's say it's $35,000, and just give it right to the charity. Okay, you'll get the deduction from your income for doing so. So basically, what that would look like is rather than you taking the $35,000, owing 33% in taxes on it, and then giving 2/3 of that RMD to charity, you can just avoid the tax system altogether and give the full $35,000 to a charity. Okay, so that's income that you don't need and you want to give it away eventually anyway. A QCD can be a great idea. Number 2, if there's a wide gap between you and your younger spouse, it might make sense to take your RMD and contribute it to your spouse's IRA. So let's say I'm 72, I'm required to take a $15,000 RMD, and my wife is 63. Okay, well, if she can still contribute to an IRA, okay, she can, I can take my RMD, which would be $15,000, that would add $15,000 to my taxable income, but then have her contribute $15,000 to, let's say, her 401k. So that would then eliminate that $15,000 from our taxable income, and essentially it would be a wash. Now, really, it's just kicking the can down the road. It's giving us a few more years to deal with these RMDs before she turns 72, but nonetheless can be better than forcing yourself into that aggressive tax bracket. And then number 3, or lastly, I should say, which doesn't necessarily feel like a strategy to some of you, is to keep working. Now, granted, nobody wants to probably work past 72, but if you're in a unique position where you can stay on with your employer in some kind of consulting role and stay on their payroll, you do not have to take your RMD from from your employer's plan. Okay, and so that's a nice way that you could delay that RMD by essentially continuing to work. Now, if you're a business owner, that will not work unless you have less than 5% interest in your company. And so there are some weird rules on that front. But for the average person, if that's an option, continuing to work can be a good way to, once again, just kick the can down the road and deal with that problem. Hopefully a little later, and hopefully implement some strategies to deal with them in the meantime. So I'm seeing, oh, no, I thought I was seeing a question there. But in summary, RMDs are something that you need to plan for ahead of time. You need to have a forward-looking tax plan well ahead of time before 72. The last point that you want to start planning for these RMDs is a month before your 72nd birthday. Okay. You need to plan for these ahead of time. Large RMDs are not a good thing. They're a good thing in the sense that it means you have a lot in retirement savings, but ideally we want to hold the large amount of your retirement savings in taxable or Roth IRAs and not have it be that tax liability in the tax deferred accounts. So prior to you having to take that RMD, you need to be using those 7 strategies that we talked about to minimize those RMDs. If you need help navigating this RMD situation, whether you're trying to estimate how much you're going to eventually have, whether you're trying to figure out how to deal with the potential tax liability down the road, go ahead and comment on this video below. Comment something like RMD minimization, and either Tony or Connie or I will reach out and private message you and kind of talk through some of the questions that you might have. And if you need more analysis, we can definitely help out with that. Okay. Tony, you are the RMD ninja. Thanks, Tony. So always remember, we say it on every Wealth Wednesday, you don't need more money. You need a better plan. Every dollar that you save on things like taxes or investment fees, or really any expense that you have, is money that you get to keep in your plan. And that either gets to keep growing, or you get to take it out as income and you get to enjoy it. So this is why we basically plant our flag on you not needing more money, needing a better plan. You don't need to worry about the next 10% growth, let's say, in the stock market, when there might be 20% worth of growth that you can have by building a better plan. And the latter option is much more safer. Okay. So thanks for watching. Let me know if you have any questions. I didn't see too many come through while I was presenting. So if you have any questions afterward, go ahead and just put them in, and we'll make sure we get them answered. Thanks for watching. Have a great rest of the day, everyone.